Today's show should help you remain calm.
Sometimes valuation can create its own catalyst. And for a large part of this year, non-U.S. markets were outperforming U.S. markets. Now the U.S. has come back, but you want to also think globally in terms of where are the pockets of valuation and opportunity. I think generally be a little cautious right now because there is so much uncertainty and the valuations are not really overly attractive, particularly in the U.S. stock market.
That's Carl Mills, partner at Cerity Partners, who in today's big interview will explain why you mostly don't react to all the things you're hearing in the news and the headlines. But up first, George Borey, Chief Investment Strategist for Fixed Income at Allspring Global Investments, will be here explaining how the downgrade of U.S. debt by Moody's over the weekend, while important, is not some earth-shaking event. And Tim Kohler, co-author of Valuation, Measuring and Managing the Value of Companies, a classic tome on investment and business management, he's here for the book interview talking about how current events are potentially changing valuations, and the results are less scary than the short-term volatility would make you think.
And what is the truth today?
That's what we hope to get to, the truth behind things. This is Money Life for May the 20th. Thank you so much for joining me. My name is Chuck Jaffe, and I'm the host here. I am a financial journalist, and this show is all about bringing you independent personal finance talk. We're dedicated to looking at a wide range of approaches and opinions on investing, and you're going to get some of that today. And I hope that there are a number of takeaways that we can make. Now, mind you, I love chatting with Carl Mills. I've done it for a long time, and I always find his voice, like just his demeanor. He's very calm. He's very laid back. He's that California chill kind of a guy. He doesn't get worked up. Like you can't really talk individual stocks with Carl because he's not making changes. If he would tell you his portfolio doesn't change very much. He comes out with long-term sensible stuff that he's going to wind up doing, and he sticks with it. But he is looking at valuations, and he is looking at what money are you adding and when are you deciding to put money to work. And there's a lot of that going on. So it's a very thoughtful interview, always is when you chat with Carl. The George Borey interview, it's important that you understand what is going on when it comes to the credit rating, because what you're going to get is a lot of people going, look at what this administration's done. This has been going on for a long time. And in fact, here's a clip from George that I don't want you to think it somehow invalidates the interview, right? Like says it's no big deal, but it is a takeaway to have on the situation.
The rating itself is just recognition of kind of where we are in the here and now. And we don't think really kind of changes anyone's perspective on the U.S. as a credit.
What is happening in Congress, what is happening governmentally right now is not helping the situation. No question about that. But this has been something that's been going on for a long time. Remember, Moody's is the last of the credit agencies to say, hey, you don't have AAA credit anymore. The others said it a while ago, like a long while ago. We've had Republicans and Democrats and Republicans and whatever in power over the time when this was happening. This is about spending priorities and things along those lines. And yes, on the one hand, it is a big deal, but it's a big deal on a very long lens. The worry is that they kick things down the road way too long. That's your problem. That is, of course, the way the government tends to do things. It doesn't make a difference which party is in power. It tends to be, hey, let's take care of what we need to right now. We'll worry about when the bill comes due. This is about when that bill comes due. So you want to know about it. It's important for you to know. But, I have people who cannot see straight about what's going on in the country in terms of they're still saying, look at what happened to the stock market. I lost all my money, or, my 401k has been wiped out. No, it was not wiped out. We went through a very quick downturn. We've now gone through a bounce back. If you're still feeling it, it's a problem with your portfolio, right? If you haven't had a bounce back, what did you do? I very seldom look at my portfolio and my total. I will tell you, I checked it at the end of the day yesterday. And the reason that I did was I knew I was close to being positive again for the year. So at the end of every year, I write down a number, and it's the number of, here's all my accounts added up. I can go take a look at that anytime I want. I know how much it was down. I had not looked for a while, and I'm now back to where I'm in positive territory. Now, I'm not exceptionally excited about that. I'm happy, but I'm not getting day-to-day emotions or anything else over the value of my portfolio. My portfolio was stress tested really well here. It did exactly what I wanted it to do. Yes, it went down. It's got enough equities. Of course it was going to go down. But it also produced income and used some things as an offset that made it that the recovery was really easy and brought it back around. And obviously, this was an easy recovery, should be for just about everyone. But if you were 100% equities, I mentioned that Gail has a retirement account that is basically 100% equities because she has thrown it into mostly index funds that she really hasn't paid any attention to. That's been much more painful. That was much more painful on the downside. And even as the things have come back, now she's not looking all the time either because it would make her crazy. But I'm not getting too excited. And by the way, if you felt that you got wiped out and you feel better, that doesn't mean we couldn't see this wipe out again. Like, this market is volatile. These valuations, as Carl Mills says, not necessarily great. You certainly want to be careful. You certainly want to be understanding what's going into it. If we can help you with that, let us know. Who should we get on the show that bring in expert opinions? Are there questions you have that we could answer for you and more? Chuck at moneylifeshow.com is how you reach me. While you're at it, send some tickers in for quick and dirty for the market call. We haven't had a market call this week, and we won't have one this week, but we've got things coming in the very near future. Excited about that. So we'll be back at it. It's just, sometimes they go in fits and starts. And I've always told you, by the way, people always ask, this is the hardest time of the year for us to book guests. Memorial Day, as you get around Memorial Day, is really tricky. Memorial Day and Labor Day. Like the Christmas holiday and the New Year's holiday, easy. Everybody wants to talk if they're in the office. There are plenty of people that are out of the office, but the ones who are in are like, it's a really easy time. Let's talk. This one, July 4th can be a little tricky. Memorial Day, Labor Day. Those are the ones that can be hard. We'll get back to those guests. So send us picks for quick and dirty, enter our contests, all that other stuff, Chuck at moneylifeshow.com. But right now, let's get on with the show. I've told you what's coming. Again, George Borey, Tim Kohler, Carl Mills, great day to live the money life. We'll prove it when the talk starts next.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
We start this edition of Money Life by going off the news. And the news we want to talk about here is the news that came out over the weekend as Moody's changed its credit rating for Treasury bills, for Treasury bonds and U.S. debt. Here to discuss it, George Borey. He's Chief Investment Strategist for Fixed Income at Allspring Global Investments. You can learn more at allspringglobal.com. George Borey, thanks for coming back to Money Life.
Chuck, it's great to be on the show, as always.
I don't want to overestimate the impact here because it's not like we didn't think this might be coming. But in terms of the impact here, how significant is this? And how quickly will we see the impact play out?
Yeah, as you point out, Chuck, this is not new news. S&P cut the U.S.'s AAA rating back in 2011. So 14 years ago, it was big news when the country first lost its AAA rating. Since then, Fitch downgraded the country, and now most recently Moody's. So it's really not a surprise to anyone, certainly not in the bond market. We did see, sort of an initial reaction in prices. We saw bond yields go up. We saw stocks go down. It sort of feeds into the narrative that the fundamental credit quality, if you will, of the country continues to erode. But that's a bigger story. And so the rating itself is just recognition of kind of where we are in the here and now. And we don't think really kind of changes anyone's perspective on the U.S. as a credit.
Does it change the perspective of the credit markets about what the U.S. needs to do or when they need to do it? In other words, you can't watch politics today without seeing how dysfunctional everything is. at least theoretically, if not in actual practice, this should make politicians say we need to have a little more fiscal responsibility. We need to tackle, the debt deficits, et cetera. Does any of this say, hey, we're now on the clock? Like, this isn't a big deal, but the next one is, and we can't let that happen. Does it create any of that kind of pressure?
It certainly creates more pressure. It adds to the narrative that the fundamental sort of underlying aspect of the US's kind of credit position. So, how much debt do we have relative to the amount of both income and GDP? How much of that can we hold? Can we withstand? And the number continues to grow. So, when you go from AAA to double A plus, or in this case, double A1, it's a marginal downgrade. It doesn't suggest that we have any imminent issue in our ability to service our debt. But as you go through time and that debt level gets bigger and bigger, which is what seems to be coming out of Congress as it relates to the most recent budget, the cost of that debt gets higher and higher. And any levered entity knows this, that once you sort of attach a certain amount of debt to your company or your country, you have to manage that debt as you move through time. And so that we think is going to be material. It does a couple things. Number one, the interest cost on the debt will continue to go up. And that means policymakers at some point, and we feel we're kind of in that point, need to decide how they want to spend money. Do they want to spend it on interest to service debt, or do we want to spend it on social programs or defense or other types of government initiatives? Those are the kind of questions that politicians will have to answer, especially as that debt load gets bigger and bigger and importantly more costly. So the pressure points kind of tighten as we go through time, but they're not as acute as you would expect from a big kind of market shock. This is not a shock by any stretch of the imagination. It is just sort of a reminder, a sober reminder that the frog in the proverbial pot is slowly boiling, or the heat is coming up, if you will. We're not at the point where we're boiling over, but the water continues to kind of warm up, is to use an analogy.
The other side of this, I don't want to get into politics, but what it also means is that whatever rhetoric we're going to hear from either side saying, this is the cause of the other guy, or everybody's responsible on this one. Everybody should be taking blame and nobody avoids blame, correct?
Well, this has been building up over a long period of time. The debt to GDP of the country has doubled basically in the last 15, 20 years. So there's been sort of consecutive administrations for a whole host of reasons have allowed the debt sort of load to grow. And the reality is our borrowing's growing much faster than our kind of growth or income. So traditional credit analysis tells you look at the debt load a company or an entity holds and how much underlying revenue are they generating. Our country still, continues to grow, continues to expand, very profitable at the corporate level, lots of revenues, sort of accumulated or received both at the federal and at the state level. But the debt load, the borrowing that the country has kind of initiated just continues to accelerate. And that's concerning. And when we look at, the most recent budget estimates of a deficit to GDP ratio of currently about 6.5%, growing to 7.5, 8, or possibly even 9 over the next 10 years, means you're going to see a considerable increase in the debt load at the federal level. And as I mentioned, once we start thinking about the cost of that debt as it relates to interest costs and the notional amount that money starts to put on the pressures for politicians, it's not going to be easy to sweep that sort of under the rug. That there will be a time, it's not today, a time when the country will need to decide, how do we want to spend our money? Do we want to spend it on servicing more and more debt, or are we willing to actually try and get our borrowing a little bit more under control? But based on the current proposals coming out of the House, and then assumedly what the Senate will likely respond with, it suggests that the borrowing numbers are going to continue to go up, not down, as we look forward.
Given other things that are happening around the world and U.S. relationships with other countries, this is still a market that foreign investors will want to be buying into. But every time you take a step down the credit scale, et cetera, you're a little less attractive than somebody else. And we're not as friendly as we used to be, and we don't have as many allies and what have you. Does that concern you at all, that at some point that creates a worsening of the impact here?
So I think there's two central messages that any bond investor really should focus on. Number one, income is your friend. And so higher yields certainly represent kind of marginally less demand from existing, lenders, but as a lender, as yields go up, sort of the investment gets more and more attractive. So as yields go up, you do tend to pull in kind of more borrowers. And I think what you're seeing today is that many investors, both domestically here in the US and international investors, are saying, I need more of a risk premium. There's an uncertainty out there. The government needs to borrow a lot of money, as you pointed out, as we've just discussed. There's not a tremendous amount of fiscal discipline at the federal level currently, and we have some uncertainty regarding inflation. So I need a higher yield at the long end. Today, the 30-year notched above 5% for a little while. We're back down below 5%. So we're kind of hovering around, sort of high-ish levels. You could argue that those yield levels should go up more because that uncertainty is fairly significant. Now, the question about domestic versus international demand, there are many treasury securities around the world held by a wide range of investors. And to date, we're still seeing very good demand for treasuries. The auctions have been fairly robust. But the second principle, so first is, income is your friend. The second is diversify your duration. So it doesn't matter if you're in the US, you're in Europe, you're in Asia, you can be anywhere in the world. If you have too much of one form of yield, that's a risk. It's a risk to your investment. And we've seen tremendous growth of dollar-denominated investments, both currency, rates, and equities. And I think there's a heightened sensitivity to perhaps overweight positions to dollar-denominated investments. And so you can see some diversification away from dollar-denominated assets. And again, the downgrade sort of emphasizes I need diversification in my portfolio. And that's something we really emphasize. We build into our strategies. We feel very, very committed to that. Number one, that income drives your return. Duration is sort of the extra bit, but you really need to diversify that duration. And diversity can be treasuries versus corporates, maybe versus mortgages, but it also can be treasuries versus bonds. It could be treasuries versus JGBs in Japan. It can be treasuries versus UK gilts. You add those bonds together and we have a nice mix. Some of those countries have very favorable bond dynamics right now. And we sort of couple that together with all the income you're getting at the front end of the dollar curve. Now I have a really good bond portfolio that can weather this storm. Income drives returns in bonds. And the real yield in bonds is substantially positive, anywhere from the 200 to 400 basis points. And my job as a bond investor, beat inflation through time. And I can beat inflation. We should be able to beat inflation today, given those opportunities domestically in the US as well as internationally. But you need a remit that allows you to bring that into the portfolio, convert it to a cash flow stream that you can use, and then compound that through time. That's what a good bond manager does. Today's announcement pushes yields up. We view it more opportunistically, but it basically underscores the basic premise: income, as much income as you can at the front end of the curve, and be very diversified with that longer duration.
George, great stuff. Always is when we get a chance to chat. Thank you so much for joining me on Money Life.
Thanks, Chuck. Great to be on.
That's George Borey. He's Chief Investment Strategist for Fixed Income at Allspring Global Investments. It is allspringglobal.com for more information. We've got a lot more to go on today's show. Up next, the book interview. Tim Kohler from McKinsey will be here talking about valuation. And it's more than just valuation on stocks. That's coming up when we come back.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Did you know that there are at least 23 million American adults who can't read a want ad?
It's called reading. Top to bottom, left to right. Group words together as a sentence.
Money Life presents.
I'm chatting with my guest, author, lecturer.
You get him to open his mind and his future.
The Book Interview.
Give a kid a book and you'll give a kid a break.
That's gonna be radical, Chuck.
Reading is good. Can we start the story now?
We sure can start the story, and this is a story that is central to anybody who is an investor or a business owner or who just wants to try to figure out what it is that they're buying when it comes to buying stocks and businesses. Because my guest is Tim Kohler. He is co-author of Valuation, Measuring and Managing the Value of Companies. It is out in its 8th edition from Wiley on May the 20th. The 7th edition came out 5 years earlier, exactly 5 years earlier. And that's when Tim was last on the show. And I'm really excited about getting a chance to chat with him because at that point, one of the things we were talking about was how valuations were being impacted by COVID and the pandemic. And today we're going to be talking about how things are impacted by tariffs. But Tim and his co-authors are with McKinsey. If you want to learn more about them, McKinsey.com. If you want to learn more about the book, there is a direct link where you find it mentioned in our show notes on today's show or where you find Tim on the guest page at moneylifeshow.com. Tim Kohler, welcome back to Money Life.
Thank you, Chuck. It's great to be here again. Thanks for inviting me again.
Let's set a little bit of a backdrop. This book, which 8th edition, 35 years now, it started really from McKinsey's consulting business. It was internal, how you guys were doing valuations, but it grew to helping people figure out how to appropriately value a business. And we're not really going to be that focused on stock market valuations. We're going to be more focused on valuation generally. But as I understand it, like this book is a real tome. It is something that managers use it if they're checking out the value of their company. Investors use it to try to figure out what they're buying. Bankers use it to try to figure out if companies are worth what they're lending them to. You know, no matter what angle you're looking at it from, valuation principles are supposed to be the same.
Correct.
But they're not always the same. They are changing. And what I remember from our conversation 5 years ago was that valuations were changing because of COVID. And that makes me start with current events, which is, you know, in 35 years, the bulk of this giant book has stayed the same. Valuation is valuation. But how much are current events changing valuation?
That's a challenging question, Chuck, and sort of similar to what we were addressing with COVID. I would argue that when we look back over time, we look back over COVID, we look over the financial crisis, we go back to .com, valuations, while the market values of companies do change, right? What we do find is the market does tend to overreact to current events oftentimes, right? But that it eventually gets back to fundamentals. So, you know, if you're a business executive or an investor, you have a choice. I mean, particularly if you're an investor, you can try to sort of figure out what everyone's going to think about current events, right? Or you can think about what the long-term fundamentals are going to be and invest that way if you're a longer-term investor. And our book really focuses on more for the business executive or the long-term investor, thinking about what the value of a company might be over time, as opposed to the day-to-day or week-to-week gyrations in the market. And from that perspective, you know, it's not surprising that the market has been doing what it's been doing recently with the constant changes in policy. Market is, you know, terrified of the impact of tariffs, et cetera. That said, in the long run, the market will focus on the fundamentals. So the key for an executive or an investor is to focus on, you know, what level of profits will companies be able to achieve and what kind of returns on capital will they be able to achieve?
That, of course, doesn't change much over time, but the way that people consider value has. I mean, it used to be that you'd say, I'm talking to somebody who's a value investor, and everybody would know what that is. Now, value investors, they run a wide range. And the market itself has changed the way companies at times are being valued and perceived. How much for you, as you're doing this book, again, eighth edition, is tried and true? It's shareholder value. It's a basic fundamental tenet of investing that doesn't change. How much of it has the school of thought actually changed or made fine line distinctions that make it somehow better or easier or more accurate to value a business today?
We, in addition to writing the book, we work with hundreds of companies every year and trying to understand, in terms of helping the companies with their strategies, we're trying to understand how they're valued in the market. Clients come to us and say, well, we think we're undervalued. And what should we do about it? Is it a performance issue? Is it a communication issue? So we're drawing on those experiences of working with companies across geographies, across industries. And what we find is that usually if there is something that we can't explain, right, relative to the fundamentals, right? Well, first of all, that is very rare, right? We still find that most companies, when you look at their valuations, especially relative to their peers, it goes down to the fundamentals of, how fast is the bit company growing their revenues? What kind of margins, what kind of returns on capital are they generating? We do find some exceptions from time to time. We try to explore what that is. So, for example, a lot of times people, prior to the beginning of this year, when valuations were extremely high, people were looking at the S&P 500 and saying, oh, it's historically high, both in terms of level and in terms of things like PE ratios. But when you disaggregate it, you find something interesting, which is that, as many people have talked about, the market as defined by the S&P 500 has really been defined or heavily influenced by, the 7 biggest companies. And what we found interesting just recently is that when we looked at those 7 biggest companies and we looked at the investor composition, what we found with those 7 companies was they had twice the concentration of retail investors as the rest of as the typical S&P 500 company, right? And that's a sign to us that the share price is driven by something other than fundamentals, right? When you see something like that happening, typically what's going on is you've got retail investors who aren't crunching the numbers. You've got trading oriented investors who are, buying based on sentiment and where they think sentiment is going. And then you've got a lot of portfolio managers who are saying, I don't want to look bad by not having these stocks in my portfolio, right? So you have all these buying pressures pushing the share price up and very little that pushes it down until, in the short term, right? Shorting is very expensive, very risky. So you don't see a lot of that. And so, if I look at sort of recently, I see, in a way, 2 different markets. I see most companies, most industries being valued rationally based on reasonable expectations of what's going to happen to that company in that industry. And I see a handful of companies who are very large, whose values are, largely explained by what's going on with investors as opposed to what's going on with those companies.
One of the questions that I ask guys who are money managers, I'm curious to put by you, because with the way we saw the growth in those Mag 7 stocks, we saw changes to the way that indexes were being constructed and companies were being evaluated. So it was just a couple of years ago where you would have had about 300 large cap stocks. But now the way most indexes are calculated, because the big got so big, you have about 150 large cap stocks. And oh, by the way, General Motors, and every time I say it, it just blows me away. General Motors is a mid cap stock. Like, literally, it was so big at one point that the folks at S&P used to calculate the S&P XGM, and now it's not even a large cap stock. But given that some of that's about index construction rather than valuation, does it make a difference to a company's valuation? Like, is GM somehow diminished by being a mid cap rather than a large cap?
We have found that, you have to be pretty small before it affects your valuation, right? There is still tons of liquidity in mid-cap companies and many smaller companies, and the valuations don't behave any differently. There's no disadvantage in the valuations. So if you're a company with more than, you know, $3 or $4 billion of revenues, you're going to be valued pretty the same with the company with $50 billion or $100 billion of revenues, right? When you get really small and there's less liquidity, less people investing in that company, then it may become an issue. We don't typically look at very small companies, but for companies, that you're defining as mid cap or even some small caps, there's enough liquidity, there's enough smart investors out there who are looking at those companies, right? A lot of investors are saying, there's too many people looking at the large caps. I'm going to focus on the mid caps and the smaller caps. And they're pretty sophisticated. So they keep their share prices in line with fundamentals. So we don't see it being an issue for most companies until you get really small.
The principles, as we've said, go back all the way to the first edition 35 years ago. But there are a lot of things that are changing. And one of the biggest changes in the world, not just the business world, is artificial intelligence. And I could see artificial intelligence being a double-edged sword. On the one hand, there are tools that you can use as your calculating valuation that allow you to analyze a business using AI. On the other hand, there are tools that a business could be using that are AI tools that somehow make it look like they're doing more than they're actually doing. So, which is it? Helpful, harmful, both depending on circumstances.
Let's take those two separate. Let's take it from the perspective of valuing a company, regardless of whether I'm using AI or not. AI can be helpful, but how does AI affect the value of a company? It's just like anything else, right? AI, there's two kinds of companies. There are companies that use AI to improve the performance of their business, right? And then there are companies that sell AI related products, right? So for most companies out there that are using AI, right? It's, it goes back to any other innovation, right? Does it reduce your cost? Does it increase your customer retention, customer satisfaction? Does it help you to identify, customers maybe that you couldn't have identified otherwise, right? Or it would have been expensive to identify. So ultimately, it's still AI still has to translate into revenues, profits, cash flows, right? So if I'm evaluating a company, I'm trying to understand that. And I'm also trying to understand how much of that incremental value is going to be given away back to consumers. Because in most cases, technology, if all my competitors are doing the same thing I'm doing, right, then the real beneficiary is going to be the consumer, right? Because if I'm doing something to increase my, customer satisfaction, customer retention, I got to assume that my competitors are doing it as well in most cases. And so maybe I get an advantage for a year or so, but it's probably not going to be long lasting for many companies. There will be some companies where, if I have a really strong market position, it is long lasting. But for the most part, I need to think, go back to the fundamentals. How does it affect cash flows? And does it create a competitive advantage, or do I need to just do and apply the AI to remain competitive with my competitors, right? Then you have the other type of company, which is the company that is selling AI-related products, which is new and is the part we don't know yet, right? Part of it we know is that the companies that are hosting the hardware companies and the whole hardware ecosystem is going to benefit, right? The companies that do cloud computing, the companies that build data centers, the companies that provide air conditioning to data centers, the companies that provide electricity to data centers, right? We can see how those are all benefiting because that's very tangible, right? And, it's a question of saying, okay, how much, right? How much electricity is going to be needed? How much, additional computing power is going to be needed? So nothing really different methodologically, just, it's how big is it? What we don't know yet is what the monetization model will be for the software itself, right? That's the big uncertainty. I think we're going to have to wait and see how that actually works out in terms of, Will companies be able to monetize the software in a way that, one company, let's say, has a bigger market, has a really large market share? Or will the market become fragmented and there'll be specialized AI tools and there'll be competition among different AI tools? We don't know that yet. So it's hard to say how that's going to play out. And then the question is, can I use AI in my quest to value companies, right? And I guess I would argue that, the applications right now are somewhat limited, and that will probably change and maybe change in a couple of years, right? I can use AI to help me screen, right? I can use AI to summarize information for me. I can use AI to extract information or data, maybe in ways that are more efficient than I used to. But there still has to be, we've already done a lot of automation of financial analysis, right? Even before AI. But there's so many idiosyncrasy amongst companies, right? That we find that you still have to, read the footnotes, right? Because you don't want a summary. You want sometimes the critical information is sort of buried somewhere and AI may not pick it up, right? So, if you want to have a unique point of view, you do have to continue to do your homework. Some of it may be automated, some of the more general stuff, some of the easy stuff. I think the harder stuff, at least for the foreseeable future, is still going to require thoughtfulness. And by the way, when you're predicting, AI relies on lots of data. And when you're trying to predict what's going on, what's going to happen to an industry, what innovations there are going to be, there's not a lot of data points, right? What's going to happen to competition? How are consumers going to react? There's not a lot of data points. So you still have to go back to more of the traditional tools that you've been using. It's not going to replace that, at least for the foreseeable future.
It sounds, Tim, like that gives you the basis for writing the 9th edition, which I'm sure we'll be talking about a couple years from now. But meanwhile, thanks so much for taking the time out to join me on the show today, talking about the 8th edition.
Thank you very much, Chuck. It's been great to see you again.
That is Tim Kohler. He is co-author of Valuation, Measuring and Managing the Value of Companies. Out May the 20th from Wiley. Learn more at McKinsey.com because Tim and his co-authors are with McKinsey. Or again, the long direct link that gets you there is in our show notes. And I'll tell you what, we know that you know the value of living the money life, and that's why you're not going to go anywhere as we take a quick break. We'll come back with more financial talk in just a moment.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Welcome to the big interview on the May 20th edition of Money Life. Returning to the show, Carl Mills. He is partner at Cerity Partners. And if you want to learn more about the firm, what he does, etc., Cerity, Cerity, CerityPartners.com. If his name rings a bell and Cerity doesn't, well, he was the president of Jerica Mills and Kiefer, which about 2 years ago was merged into Cerity Partners. But Carl's been coming on the show basically for the entire 13 years of Money Life. So he is somebody who I know you guys like hearing from. He is someone I definitely love talking with. Carl Mills, it's great to have you back on the show.
Great to be back, Chuck.
You are always someone who is preaching patience and calm, and that's your demeanor, and it's worked very well for you and your clients. These are times that are freaking people out. How do you get people to stay calm when this time feels so different, even when we know that the most dangerous words in investing are this time it's different?
That's a great question. Each time always feels a little bit different, whether it was, the dot-com crisis, the COVID, and now this one. It's like each episode comes out of left field. It's not expected, and people say this time it's different. But if you just look over the history of markets over 100 years or more, the markets have survived wars and depressions and recessions and all kinds of events out of left field. And There's an enormous resilience to the U.S. economy and the global economy and stock markets that you don't want to discount. And that's why, we always preach staying along for the ride. I think there are times to drive in the fast lane and times to drive in the slow lane, be conscious of what the conditions are. But you really never want to get off the ride because the market will always do the opposite of what most people think it's going to do.
Fast lane or slow lane now? Because on the one hand, everyone wants to be defensive. On the other hand, when everybody else is being defensive, you can sometimes make pretty good headway.
Yeah, I think, where you're driving matters too, but we're generally in the slower lane right now. And, if you just sort of step back and look at what's going on, one is there's a tremendous amount of uncertainty that's still prevailing as a result of tariffs and tax policy, and no one really knows what is going to stick or not stick. People have beliefs about this, but this is all new as opposed to from, even 3 or 4 months ago where people had a different set of expectations about things. So there's still uncertainty about those two things, and it makes it harder to run a business. So I think of these things like friction. They don't prevent things from happening, but they make it harder for things to happen. And that tends to have an impact on growth. It slows growth. If tariffs are enduring at some level, they're going to cause higher pricing for a period of time. They're also going to probably result in a reduction in demand. So, higher costs and slightly lower declining sales. That means probably slower growth for earnings in the S&P 500 and other stock markets. Then you want to look at the valuations that are being applied to that. And we're still at a fairly expensive market. Things got cheap in April for a period of time, and then things violently roared back, and now we're higher than we were. So you're paying a fairly high price for expectations in the U.S. stock market right now. Conversely, if you look at outside of the U.S., international markets are still quite cheap. They have their own challenges and issues. They'll probably be impacted more by trade wars, tariffs, and uncertainty than the U.S. economy will be, just because of its inherent diversity, and it has more innovation going on in it. But sometimes valuation can create its own catalyst. And for a large part of this year, non-U.S. markets were outperforming U.S. markets. Now the U.S. has come back. But you want to also think globally in terms of where are the pockets of valuation and opportunity. So, I think generally be a little cautious right now because there is so much uncertainty and the valuations are not really overly attractive, particularly in the U.S. stock market.
When you talk about the valuations not being attractive, particularly in the U.S., where are you going internationally and how comfortable are you going there, given that they're on the other end of the tariffs? Their valuations may be great, and they may even be helped by the changing power of the dollar. But how do you get comfortable going more into the area that a lot of people see as the eye of the storm?
Well, like I said, sometimes valuation can be its own catalyst. And so if everybody has low expectations for a region, if they can just stumble out of bed and, drink a glass of water, they may surpass expectations. And so one of the ironies of the trades, the tariffs and the uncertainty and, declaring a blanket trade war against much of the developed world is that it causes those economies to start to do more things for themselves, which may mean an increase in fiscal spending. So there's more money going into non-U.S. businesses, a fiscal response in Europe, a fiscal response in China, a fiscal response in India. There's a lot to the world outside the United States. And so, I think sometimes, the valuation alone can become a catalyst. We still are very much believing in having a globally allocated portfolio, and the diversification this year has been really important. And we think it's always a good idea to be diversified because you never exactly know how things are going to play out. People have a lot of high expectations for the U.S. There's a lot of high expectations for technology growth in the United States. As we've seen, there can be a lot of downside when those companies don't live up to high expectations. So you're always wanting to compare expectations versus fundamentals.
Are you leaning towards developed versus emerging markets? And what do you do with China in all of this?
Well, China is, I think it's always good to unpack, don't think of the developing world, emerging markets as a monolithic thing, because, you have China, you have India, you have Brazil, you have the Middle East, and each of these economies and economic regions has its own drivers. Like Brazil is a major exporter of raw materials, food, and energy. China is a major importer. So what's good for one isn't necessarily good for the other, and vice versa. India has a very different economy than China has. And so I think there's a tendency for people to just write off, emerging markets or developing world as if it's one thing. But, India had a very good year last year, and China, the valuations are a lot lower now. So, for example, the trade talks with China, which sort of came out of the blue, everybody thought China would be the last in line for trade talks, and now it's at the front of the queue. If we're able to come up with a meaningful sort of new trade agreement with China, that, I think you'd see a lot of money start to flow back in towards China and to Asia and emerging markets. So, it's not an overweight for us, but I wouldn't count it out either. I do think it's important to look underneath the hood of markets to sort of see where there are pockets of value and pockets of sort of excess valuation or excess expectation.
Let's talk a little bit about that calm and that resolve you try to preach to your clients to have during times like these. Have you noticed from the standpoint of their emotions, things are different? Are you seeing more strident reactions? Is it maybe more tied to what you know about somebody's politics or any of those other things that has them saying, I'm able to stay calm or I cannot keep my calm?
I think that's a great question, because I do think that information flow now, it gets exaggerated and, siloed more easily or more than it did in the past. So we have clients across a whole range of the political spectrum, as you might expect. And, a general rule of thumb is never mix politics and investing. You really want to focus on fundamentals, economic fundamentals, market fundamentals. So we have clients that, in the nadir of all the bad news, were wondering whether they should buy bottled, canned goods and bottled water. But others were saying, should I be adding to the portfolio? Often people with exactly the same balance sheets on a spreadsheet, but completely different views of the world, depending on what their news and information flow looks like. And that's where you want to basically have them step back and look at market history, really point out that, first of all, downturns are a normal part of the market experience. And, on average, I think it's 10 to 11% a year, but that includes some really painful years and some relatively mild corrections. They're never fun when you go through them, but it's important to know that markets can come back very quickly and often violently. You really don't want to miss the big up days. They tend to be interspersed with the big down movements, and you kind of need to be along for the ride. And that's where I think picking a lane, going back to driving, where you're comfortable is really important. And, now I'm going to switch metaphors, but I also think it's really important to communicate with clients a lot during times of turbulence. You may know that the aircraft has been engineered to withstand severe turbulence, but you like hearing from the pilot that there's going to be bumps and this is what we're doing. I think it engenders confidence of the clients that somebody is paying attention in the cockpit and that these are normal circumstances, even if they don't feel that way.
Again, it's a little different talking to you than it is talking to a fund manager or somebody who works as the chief investment strategist at a big investment firm, because you've got real people at the other end of your decisions who they are your clients. When they look at you and they go, but my kid's getting married and I need to pull money out for a wedding, whatever. Is this where you say, we pulled enough cash for you to have this? It shouldn't be a worry. Like, where is the rubber meeting the road on those things? Because we're hearing that consumers are pulling back, yet that's not what the spending numbers necessarily say. So I'm curious as to what your experience has been with folks who they're in the crosshairs of this, even if they're really not, even if they've got enough assets to live it out, they're still going, wow, it's become really expensive to do these repairs that I wanted for my house or to buy that next car or whatever it might be.
I think there's kind of two questions in that. The first is, have I noticed a change in my clients' consumption behavior? And maybe a little bit. Like certainly mortgage rates being where they are have slowed down home purchases, or how it changed the way our clients are thinking about purchasing homes, whether they want to finance them or not. I've seen some change in where people want to travel. Some people saying, well, I'm going to travel domestically this year. I don't want to, go to Europe. There's just too much uncertainty around the world. But with respect to, has it had a big impact on overall consumption? So far, we haven't really seen that, at least yet. Now, the second part of the question is more of a financial planning question. If you came to me and said, I have a wedding coming up in 9 months that I have to pay for, that's a certain liability or a certain cost you're going to have to bear. Then this is a financial planning question or consideration. Then we'd want to see that money parked in a defensive place so that you know that you have the money to pay for it and you have peace of mind for that. Money that's committed to the markets, the stock markets, I think you want to have a longer term time perspective for that, like 3 to 5 years or longer. That's long-term money where you're willing to absorb the volatility of the markets because you know that over time you're going to get appreciation.
I'm not calling you old. You have seen enough of these events, however, in the past to be able to judge. Does this feel like anything else? Like, what would be your reminder? Because it's not quite inflation of the 70s. We weren't old enough to remember Smoot-Hawley 100 years ago, but even there, it doesn't quite feel like what we've read in the textbooks. So what, if anything, does this remind you of?
It doesn't remind me exactly of anything because this is sort of a change in geopolitics that's occurring. And I think an overall trend towards economic nationalism. Probably the most important takeaway is you don't want to think of these changes monolithically because it's, the global economy is a multi-dimensional puzzle. There's multiple things going on at the same time. So you have a movement generally towards more economic nationalism going on around the world. You have changes at the margin in political structures and decision-making. But you also have AI coming on, which is, I think, another transformative technology like during the dot-com era that's going to generate a lot of growth, and we're going to see a tremendous amount of change in our lives in the next 5 years. And I think that could be a powerful source of positive change for many industries, many types of jobs, and solving difficult problems. So I'm pretty optimistic about that. So you don't want to just sort of look at things one way and get overly, optimistic about the world based on one kind of train of thinking or pessimistic based on another train of thinking. I think you need to think of the world economy and investment market as a more complex system, which is why you kind of want to be diversified and stay invested and keep calm and know that these kinds of things happen. Like we'd never been through a pandemic before a few years ago. Now we can look back and say, yeah, that all makes sense. But it was scary at the time. And this was scary at the time, and then we've seen policies change accordingly and, or in response to markets declining. And so, that's why I remain kind of a confident long-term investor. I'm always nervous. I've been through enough of these kinds of things. They all feel different, but to know that the sun tends to come up the next day and there's usually to a problem, there's usually a response and a solution and things recover and then move forward.
Well, Carl, I have more questions I could ask, but I've gotten to the spot where we have to move forward on the show. So we're going to call it for now, as long as you'll promise me that you'll come back. We'll talk again in about 6 months, and we'll see if maybe it's played out enough that we have a little more sense of the right thing to do next.
It'll be my pleasure.
That's Carl Mills, everybody. He is partner at Cerity Partners. Cerity, Cerity, CerityPartners.com if you're looking for more on the firm. And we will come back, put a bow on this show. So stick with us till the end. The finish line is in sight, and we will cross it right after this message. This is Money.
Hi everybody, it's Rob Floyd, Money Life's executive producer, and this week we have a marijuana-themed contest for a chance to win Weed Empire: How I Battled Gangsters, Investment Banks, and the Department of Justice to Build the Cannabis Industry in America by Adam Bierman, who appeared on the May 16th edition of the show. For a chance to win the book, you simply need to give us the name of a ticker symbol of a real marijuana ETF. Think tickers like HI, but for marijuana funds. Send the name of a marijuana fund with a fun pot-related ticker symbol, along with your name and address, to chuck@moneylifeshow.com by 6 p.m. Eastern Time on Wednesday, May 21st, for a chance to win. Please put the word contest in the subject line of your entry. Good luck.
We are back to wrap things up on this edition of Money Life. Hope you had some fun. I always love talking with Carl Mills. We've been doing it for a long time. He's another of those folks who was on the show very early, and I've known him for years. Knew him well before we were doing the show as well. So, great stuff. Hey, I had mentioned that on tomorrow's show, we're going to have Chris Zaccarelli, the Chief Investment Officer, and I had mentioned him with his old firm, which was the Interactive Investors Alliance. He's now with Northlight Asset Management. So he will be here tomorrow. We will also have Jordan Rizzuto from Gamma Road. They have this whole system that they use, really interesting in how they divvy up the market and what's going on. Very cool to get a chance to catch up with him at this particular time. So you may not like what he's got to say. I will warn you about that. Meanwhile, if you are looking for something to celebrate today, it is National Millionaire Day.
You can be a millionaire.
Yes, you might be able to be a millionaire unless you're lucky, in which case you already get to say,
I am a millionaire.
Yeah. Let's hope. You know, the only people that don't want to be millionaires are billionaires. It's also National Streaming Day. Don't people celebrate that every single day? It is National Rescue Dog Day. And I love the idea of a rescue dog. With Gail's allergies and my having been mauled by a neighbor's dog as a kid, I've never been able to do it, but I love it. And I support actually rescue dog charity. And Stash is a rescue, actually. Stash, Gail's dog, but it had to be a certain type of dog for her to be able to do it because of her allergies. And Stash is a little Yorkie. Then on the food front, it is National Sugar Bee Apple Day. Sugar Bee apples are actually really sweet and good. It is National Pick Strawberries Day. You're not supposed to just eat them. You're supposed to pick them. And it is National Quiche Lorraine Day. And remember when there was the whole thing about, like, do real men eat quiche and all that other sort of stuff? I love a good quiche. I got no problems with it. But quiche Lorraine, you don't have to twist my arm, though I probably won't eat one today. My guests today were George Borey, Chief Investment Strategist for Fixed Income at Allspring Global Investments. It's allspringglobal.com. You may remember he was on the show doing a big interview like last month. We have rules about how often somebody can come back on the show. It's all about being in the same thing. So like we don't do a big interview and then have them back in short order because we're afraid they'd say the same thing over and over again. We want to let time pass, get more guests. But when they're going off the news like this, that's a thing that we will bring someone back for. And I appreciate George stepping in on short notice. We also had Tim Kohler, co-author of Valuation, Measuring and Managing the Value of Companies. It's out from McKinsey, McKinsey.com. And then Carl Mills, partner at Cerity Partners, CerityPartners.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Josh Brown, downtown Josh Brown, who's been a guest on the show a few times, who said, once you've succeeded financially, you've only just begun to succeed personally. Yeah, and that's an important thing to keep in mind because you want the personal success that usually comes after the financial success. But you want to keep your eyes on the prize to get that, which means you need to remember that until we do this again the next time, best thing you could do for your money is not worry too much about it. Have a great day, everybody. Safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Okay, save your batteries.